Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Chevron. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Kelly. Well, if we look at the S&P 500 index, we are flirting with that 4,000 level. What do you see going on in the markets as we head into the end of the week?
Yeah, Brian. Well, flirting is actually the word I was going to use. So the S&P 500 today is flirting with 4,000, and it's back at record highs again. So all good in the stock market so far. We're back to record highs as vaccine distribution has ramped up a little bit, and as investors continue to process a third round of stimulus. We're not up super high today, but we are back at record highs and pushing a little bit higher. So all good news so far. Thinking about the bounce, so we did see quite a sell-off in the stock market. We saw about a 4% sell-off in the S&P up until about a week ago. And the bounce back, stocks have bounced back. The bounce back has been led by tech stocks, which are up about 8% over the past week. It makes sense. Tech stocks were the hardest hit during the February pullback, and they're especially sensitive to short-term swings in market momentum. So that's what we're seeing. Tech bouncing back, especially today. Stocks up a little bit higher. So the big question is, where do we go from here? This week I think could be a big tell in that area. We have a Fed meeting coming up. It's ending on Wednesday, which means we'll get a policy announcement plus another press conference from Fed Chair Jay Powell. And as we all know, markets have been spooked by inflation fears lately, and the Fed holds the key to market mechanisms around inflation. So investors will be watching Jay Powell especially closely. As usual, we don't expect the Fed to do anything too drastic, but the market will be dissecting every word he says. If he's too dismissive or if he's too combative about inflation, we could see stocks respond negatively, maybe sell off a little bit. If that happens, it'd probably be a pretty quick sell-off, but that's something to watch for and, something to maybe expect. We're also listening, when we're listening to Jay Powell, we're also listening for comments on economic growth because we expect Powell to keep economic expectations low. From the Fed's perspective, you don't want to set the bar too high. But his tone around the economy could change from what we've heard in the past, just because vaccines are rolling out that quickly and we are getting that much closer to the end of the pandemic. So let's take a look at other markets. The 10-year Treasury still stands out in my mind. It's still hovering around a post-pandemic high of 1.6%. And we could see it move quite a bit with the Fed's comments, depending on what Powell says. Oil is definitely another market to watch too. Crude oil, which we'll get to in a second, is down today, but it's up about 30% year to date, which is a huge rally. And it could be in a prime spot for more gains as demand picks up. All right, I don't want to steal your thunder, Brian, but another market to watch right now is the VIX, because the VIX has actually fallen below 20 today, which is a really big deal in the options market. So tell us about it, Brian.
Well, all right, let's start by looking at the watch list that we have on the VIX that we've been looking at week in and week out here on the Stock Play of the Day. We see the SPX up 3 points today, but we actually see the VIX down below the 20 level. The spot or the VIX index is showing 19.62 today. Now, if I look at the chart, I'm going to highlight this over on the right-hand side. We had one point in time where it got lower than that since the pandemic. And I'm going to highlight this row right up here, and I'm going to kind of take a peek at it if I can get my cursor just right. We got down to about 1950, and I quite get there, and back in November. And we ended up closing above the 20 level. So if we can get a close below the actual 20 level, This will be fairly significant in the marketplace. A lot of people have been talking about it on all the financial news. And to go along with the drop in the spot index, we also look at the April and May futures contract. And we see that April has came down precipitously, a fairly big drop since over the last couple of weeks, down from about 28 down to 23.40 today. And the May contract is pushing the 25 level. So the longer term futures contracts are also showing the market expectation of volatility to come back down a little bit as we get into the summer months. So you have the futures contracts and volatility coming down. If we can close below 20 today in the VIX and maybe stay below that for this week, overall, that would be showing that some of the uncertainty or nervousness in the marketplace is finally precipitating. And as we go into the summer months and we get a little bit more of a rally in the marketplace, it means to me that people are believing more in these highs that we are setting in the S&P 500 index. NASDAQ is finally bouncing back a little bit. And then we also see the Russell 2000 index also being very strong as we head into the end of March here. So now, with that said, you mentioned oil. So we see oil is down today about $1 or 1.4%. Going into the summer months, it has been a little bit higher demand as far as people are now coming out of their houses. They're doing a little bit of driving, a little bit of traveling. Airline stocks and travel stocks in general are up. They're seeing better bookings going into the summer now. That also means that they might be adding more flights. There might be more demand for oil, or even more so on the gas front overall. So I want to take a quick peek at the stock of the day that we're going to talk about. Before I send it back to you, let's look a little bit at Chevron. It's an interesting chart. Now, if we were looking at a shorter term trade, which we're not, we're going to go out till looking at oil and gas and Chevron and energy going out to the end of the year. But if I highlight the Fibonacci's here, we see it in red if I put my cursor over that Fibonacci line. Before the big downturn, we had a little bit of a spike, but going all the way down to the lows of March over a year ago, we see a very interesting situation at the 61.8 level. That's the Fibonacci number where we came back, hit that 50% retracement level, traded sideways for the longest of time, kept bouncing off the 61.8 level. And once we broke through that, we had a very strong move to the upside. Now, where was our next stopping point? And I'm going to highlight, I'm going to bring my cursor all the way back to that March area. And we see this little try for Chevron trying to go back to where it was to its all-time high. But right here, before we get that big downturn in the marketplace, notice that that's exactly where we stopped recently in March. So that's a significant level. Right now, we've had obviously some sell-off after we've touched that point. So it's a little bit of, where do you want to pick your spot? Are we doing a little bottom fishing relative to that actual resistance level to the upside? That could be overall. But our outlook here is more so for demand in energy company, demand in energy overall, as we are slowly digging our way out of everything that has been caused by the COVID-19 virus overall. All right, so with that said, Chevron, let's take a little bit of a look at the fundamental situation in Chevron. And I have to say, it looks like Warren Buffett kind of likes Chevron overall based off his positioning before the end of the year and some of the trades that he placed in Chevron overall. So back to you, Kelly.
Yeah, well, man, I have some big shoes to fill if Buffett likes it. So today's stock of the day is Chevron. And Chevron, as you probably know, is a massive oil refiner and transporter. So as you can see on Brian's chart, and as you can imagine, the stock has been hit pretty hard over the past year. But it's one of the dogs of the Dow, and we know every dog has its day. And the Dow has done really well lately. So, Chevron's kind of gone along with that. Chevron has risen nearly 31% this year. And that's an impressive rally when you compare it to the S&P 500's 6% gain year to date. So why is all of this happening? Why is the Dow doing so well? Why are energy stocks bouncing back? Well, Brian kind of told you, oil is back, baby. There's a super interesting story behind oil too. I mean, oil prices are up on expectations for higher demand as the economy reopens and people get comfortable enough to start traveling again. Because if you think about it, you're going to take a train, a plane, or an automobile, you're going to need some fuel, and fuel is oil mostly. There's also a global economic recovery story there too. As global growth increases, and that's what it's looking to turn out to be as the pandemic ends across the globe, oil demand could pick up too, and that's driving prices higher. So, oil has been the big driver in Chevron's price, and Chevron has been a big driver of the Dow's relative success lately. The Dow is actually leading the S&P 500 and the Nasdaq 100 higher this year, a trend we actually wrote about in Friday's weekly viewpoint. So shameless plug, go check that out on the community hub. You know, Chevron has had a really good year, and we're still feeling pretty good about Chevron over the next few months. Chevron right now is trading at about $110 a share, and it finally just reached its pre-COVID peak. If this rotation story continues, we could see energy stocks continue to surge throughout the summer. And we especially expect that if growth booms this summer and travel picks up. And to be clear, I mean, Wall Street agrees with this too. Analysts' average 12-month price target for Chevron is about $116, which is about 5% higher than where it's trading right now. But to be very clear, we are a little more nervous about energy over the next few years. You know, it got hammered along during the pandemic, and we feel like there are some societal trends that could limit profit growth going forward. So to be clear, this is more of a, I want to say short term, but it's more of a medium term play in our view. You know, over the next few months, going into the end of the year, you know, maybe we could see energy stocks surge. Beyond that, we're not so sure. But for the summer, Chevron could be an interesting options play and an interesting stock play. So I want to hear about Chevron options, Brian. But before I pass it over to you, I want to remind all of our viewers to please drop questions in the chat. If you have questions, hopefully Brian and I have answers for you. All right, Brian, what do you think about Chevron options?
All right, so I'm just going to make a couple of comments on the oil before we jump right into the option chain. But overall, if you see oil, as Kelly mentioned, in the U.S., we're seeing consumption starting to actually skyrocket a little bit as we get more and more vaccinated and more people are apt to travel. But we still see it a little bit down in Europe. And one of the big things that happened this week is Italy is heading back to another lockdown. So even though we're seeing consumption grow in the U.S., overseas, it's still kind of in that iffy stage. So as we become more and more vaccinated as a world, this is a little bit more of a reason why we're looking at over the summer months, maybe getting a little bit more bump in some of these energy stocks. So if I look at Chevron and the Ally Invest option chains, I see one big thing. We see a big dividend. $1.29 is the dividend per share. And the ex-dividend date was back in February. But we're going to go out further in time, and it's worth noting that if a stock pays a big dividend, that actually lowers call prices overall. It would increase put prices, lower call prices, because it's a known event where the stock price will actually go down after the ex-dividend date by the amount of the dividend. So we're down a little bit today. So today isn't a great day to be looking at a momentum play as far as options are concerned. If I was doing a shorter term trade, I would be waiting until we got a little bit of more of a bounce back. But we're kind of bottom fishing after we got back to that high just before the big March turn down, hit a little resistance on that. Now we pulled back a little bit. So we're going to go all the way out to September because of that. We're going to do the September option contracts, and those are 185 days away. And it's going to be a little bit of a FOMO trade, a fear of missing out. We're trying to position ourselves in Chevron. If I was, let's say I was going to try to buy 3 option contracts that are going to be representative of 100 shares of stock, I would look to buy them in chunks. I'd look to buy one maybe now, see if what the market does over the next week. Buy it a little bit lower, buy it a little bit higher, but I would dollar cost average into a bigger position on Chevron if you wanted to get long Chevron throughout the rest of the summer. So the September 17th expiration, we see got a little bit of a wide market, and I've mentioned this a lot on the stock play of the day. One of the biggest concerns about buying in the money longer term options is the width of the bid ask spread. It's not bad. We got some decent open interest. I'm highlighting that on our call chain, 1,087 contracts. We want to buy it as a substitute for the stock, so we're going to buy some delta. The delta of this option contract is 77. That means that if the stock goes up 1 point, we're looking for our option contract to go up about 77 cents, all theoretical. And implied volatilities have came off a little bit as we go out further in time, but they're still fairly high, especially for an energy company. We see that this implied volatility that we're buying is right around 28%. Now, I'm going to emphasize here that this is a paper trade, not meant to be a recommendation. We're just trying to learn here on the stock play of the day. And whenever we're looking at it, we're trying to say, well, if you have this situation, we have a $100 stock, we have oil prices, try and decide where they're going to go. Are they going to break out to the upside, go to the 70, 89, 70 or 80 level, or are they going to come back off and go down below that 60 level? That's a big question as far as Chevron is concerned. So how can we take a position in Chevron without all the risk of actually buying that stock outright or buying 100 shares? And that's what we're looking at today, a long call. And this is actually the long call strategy inside the options playbook. I'm going to highlight that for just a second here. And then let's bounce back and let's put this in the right rail. And you know what happens when we put it in the right rail? That makes it the official paper trade for this week. So if I scroll down, here's what we're looking to do. We are buying to open one contract of the September 17th expiration, 2021, 95 strike call option. Limit price, well, the ask is 1710. We're going to try to work this order a little bit. It's a little tough to work longer term option contracts. So the midpoint would be about 1650. We'll go 1655. That will be our limit price on this order. It would be obviously a day order, but when we're trading longer term options, we're never going to do it at market. The markets are just too wide. You need to work that order and you need to try to find where that sweet spot is to get filled. If you're doing a limit price between the bid and ask, never a guarantee of the fill. And as always, you got to think about commissions and add that to your bottom line. So if we did this trade, though, this 1655 for $1,655 would be our max risk on this trade, going all the way out to that September 17th expiration date. So if I look at the profit and loss graph real quick, I will ask you if you want to put your questions in the chat box, feel free to do it right now. But I'm going to scroll up here a little bit and we will take a look at what it looks like as of right now on our Ally Invest profit and loss graph. Okay, so we're buying the 95 strike. The stock is here about 108. And this is where our max loss would occur. From 95 on down after that expiration date, we would not lose anymore. Whatever we paid for it is what we could lose on that underlying. Right now, we see the colored line being quite a bit above the actual dotted line. So we want it to move up faster rather than slower. And that's usually the case when you're buying options. Time decay would work against you. But we have 185 days. So I'm going to go all the way back and let's knock this all the way down to 5 days remaining at expiration. And then we see that colored line kind of come in line with our dotted line overall. So we'd like to move to be quicker rather than slower, but we have plenty of time for this trade to work out overall. All right. Kelly, let's go and look at the chat box. If you have any questions, please feel free to put it in and let's try to answer some of your listener questions. What do we have?
Yeah, for sure. Well, we just got a really good question from Rahman R. Hi, Rahman. Apologies if I mispronounced your name. Rahman asks, how about trading XLE instead of CVX? Any ideas there, Brian?
Yeah, well, XLE is solid. But obviously, if you're trading an ETF and you're looking at that position, you're talking about a slower moving underlying, which is okay. There's nothing wrong with that scenario overall. But if I'm thinking about that XLE, it's an interesting way to play it, but you might just want to buy the option or the stock outright. The XLE, I think, is around a $30-some stock or underlying. It's an okay trade to look at. We were more so looking at the CVX because it is part of the dogs of the Dow. And overall, so it was more of a play on how good the Dow has been doing relative to the rest of the market here in the short term.
Yeah, and I'll add to that too, Ramon. Brian is exactly right. We're trying to look at like big name energy stocks when we're playing this rebound in oil. The reason why I say that is because the smaller energy stocks, could rebound pretty quickly, especially if they sold off more than like the Chevrons and Exxons of the world. But we think smaller energy stocks could have more, issues going forward. We're not as excited about the energy space over the next few years. But we think that Chevron and Exxon and some of the bigger name energy oil refiners are more of a pure play that you'll see against oil. And it's important to add too that, smaller energy stocks like the ones that you see pop into XLE, they're not as liquid and they might not have as liquid options trading on it. I mean, Chevron, we see a liquid options market. So it's a little bit easier to make options trades in there and to be able to trade when you want and at the price you want. So, in general, we're looking at big energy companies when we're looking at a short term or over the next few months of play in energy. So Chevron really popped out to us, especially because it's driven the price of the Dow higher. So I hope that helps. Let's see, we have other questions. So Wayne, hi Wayne, good to see you again. Wayne asks, hey, Brian, would you suggest selling some monthly or weekly calls against the Chevron September 17th position? And as a follow-up question, what strike should we sell of the weeklies or monthlies?
All right. Well, the strategy that Wayne is highlighting, I brought up before on other stock plays of the day. When you're buying longer term option contracts, we always like to kind of pay attention to how much time premium you're buying, because you aren't buying the underlying stock. You're buying some real value, some intrinsic value by going deeper in the money and getting a higher delta, but you still have some time premium on that position. So a common thing to do would be to sell shorter term calls against that position. And I'm highlighting this right now. That strategy actually is called the fig leaf inside the options playbook. And it just is highlighting inside the options playbook that this is an alternative to a covered call position. The name fig leaf comes from the fact that you're kind of covered. You are covered in that you have the right to buy the stock at the lower price than you are taking on the obligation to sell the stock at, but you still don't own the stock. So if you're doing this trade, you really don't want to be assigned. You don't want to have to give up your leaps or longer term position. We're not looking at a leap option, but we're going out 185 days on this. So to follow up with Wayne's question, he's also asking, what strike or strategy would I look at? I'm going to err to the side of being shorter term when I'm looking at doing a fig leaf as opposed to the covered call. In other words, I want the shorter term expiration. And then I also want to go as high up in strike, meaning that there's less likelihood that it's going to get to that strike price. So I don't have those on the chain, so I got to pull them up right now. Let's say 16 days out, let's see where we're at and see how much premium we can get. A lot of times if I'm selling covered calls on a stock, let's say I bought 100 shares of the stock, I'm going to try to get at least $1 or $1.50. Here in this instance, I might try to get a little less. So mainly because I'm willing to go out further in time and up, go shorter in time and up in strike just to try to avoid being assigned on it. I'm literally just trying to capture premium. So if I look at this situation, if I look at the 115 strike on the weekly expirations, which is April 1st, 16 days away, if I'm looking at that trade, I can look at the 115 strike and I can still bring in a nice amount relative to the cost of the leap option. Now, also remember, leaps aren't as expensive as the underlying stock. So when you take in a smaller premium by selling that call option, it's still a higher percentage of the total cost of the leap option. So in this instance, I'd maybe look at selling this 115. It's at 53 cents by 55 cents. So we're talking, or by 56 cents. So maybe work it at 54 cents. See if you could get a fill in that range. And that would be my fig leaf trade after I put this on. Now, if I'm doing trades like this on underlines, I always want to avoid earnings too. Right now, we don't have an anticipated earnings date. It's not the earnings season for the energy companies yet. But I don't want to be in a short call position around earnings in general, because I don't want to cap my upside on my lead and still have a substantial downside if the news is bad. So I'm always avoiding those situations because I'm just trying to bring in enough premium to help pay for some of the time decay in my longer term option contract. All right, so a little bit long-winded there, but I know we have a few more questions. Let's try to get to a couple more.
Yeah, so I'm not seeing any. Yodu, hi Yodu, did ask if we could send over a link for the newsletter I mentioned. And just to reiterate, we write a newsletter every Friday. Lindsay Bell and I do. It's called the Weekly Viewpoint. I think there's a link to a link to the newsletter in the chat right now. But definitely, check back at that page every Friday because we do publish every Friday. Sometimes with more macro ideas, sometimes with more sector or single stock specific ideas. So definitely check that out. I actually have a question for you, Brian. So why did you choose the September expiration? Why not August? Why not October? Why September?
It was a little bit based off of what was available. I don't think we had an August expiration that was available, but I really wanted to just get through the summer months. I wanted to get through the driving season, trying to see if demand will increase as we get into it, and also kind of targeting September as a potential for us to be much more vaccinated. So overall, it's a little bit of a play on the pandemic, on the summer driving season in general, and that's why we want to get long a little bit of oil and do it via the option contracts just to try to manage your risk overall.
Yeah, I like the way you think, Brian. We're definitely in the same boat there. Yeah, any play that we see in energy right now is definitely over the next few months. It's definitely a summer play. So we're right on cue there. All right, checking the questions. Don't see many more. So how about we wrap it up here? Thanks for all the questions, everybody. Thanks for joining us. And I want to remind you that Brian, every Friday, revisits this trade and sees how well we've done in Stock Play of the Day Overtime. It's a YouTube show that we host here every Friday at 12 p.m. Eastern. So definitely check that out.
All right, everyone, that's going to be it for this edition of the Stock Play of the Day. Please remember to click subscribe and ring the bell so you get the alerts for all the upcoming editions of the Stock Play of the Day, and we'll see you this Friday.